Welcome back to the Mike Rosehart Show. We're live again for another episode, and today we're going to talk about what's happened in the last week. It has been a crazy week. It's one of the most bearish weeks as far as market sentiment reversals that I've seen all year. Maybe we got a taste of this during the SVB, banking collapse and government bailout of the bunch of those banks that were basically having a run on them. Sorry, I'm just finishing a vitamin here, guys. So what happened this week? So we've watched the NASDAQ peel off 7% in the last month from the highs of even 2 weeks ago. In the last 2 weeks, we've seen 78%. We were down almost a full percentage reversal today on the NASDAQ. S&P 500 has been dumping. If you look at the CNN Fear Greed Index, I like to use it as one of a few benchmarks for market sentiment. We were very greedy in end of July. It was almost like 82 out of 100. We're now at 24 and extremely fearful on the market sentiment, current stock breadth and depth, as well as just current market sentiment. We're seeing inflation pressure, I guess, subside. So people are now expecting inflation to fall because last Wednesday, Jerome Powell gave it to us dirty. And he was like, yo, rates are not coming down. We're going higher in 2023, and they're not coming down in 2024. It's going to be higher for longer. And whether that's true or not really depends on economic data. And that was when pressed during the Q&A last week, he was like, I'll know it when I see it, which scares the shit out of people because we all want to know what's going to happen. And so that's been sinking in the last week. You look at the inversion and the steepening of the yield curve. Current interest rates are pushing all-time highs in the last 2 decades right now. So mortgage interest rates, car loan interest rates, default rates are skyrocketing up 100% in the, in Ontario, default rates are already really low. So that stat sounds scary, but it's going from like a 1% default rate to like 3 or 4%. But still, I mean, default rates are rising substantially. And the worst of it is there's fear. Fear led, at least in a large part, by rising gas prices, rising taxes. The price of oil right now, insanely high. Commodities are just ripping, like copper, again, steel, things in the manufacturing sector, not looking very good. On top of that, the strike right now across Ford, GM, United Auto Workers are all on strike. So there's a whole bunch of things happening. At the same time, the US is pushing government shutdown again due to their overspending. And a lot of that overspending is, again, due to high rates. So it's like they have to print their way out of high rates, but when they do, they force more inflation, which then forces the Fed's hand, which then forces rates higher, which makes things worse for the government. And so we got a whole bunch of things happening all at once. I've been bearish all year. Not all year. I was bullish until like February, March, April. Then I sold off all my Facebook mantle. I regretted it. I know, we've been rehashed this. I'm back to long. I have no open short positions. I have hedges on my long, but I'm now long names again, like Meta and a few other names I started putting back into my portfolio. So I am long names like Enbridge. I'm long a whole bunch of stocks right now, and I'm gonna continue nibbling through this dip that we're getting. We've seen, again, a 6 to 8% reversal of valuation. $1 trillion in global market equities gone, right? And real market cap disappeared. Now let's switch to real estate. So that's like the stock for those people who come for the stock stuff. Again, I'm not trying to focus on the stock stuff anymore. I don't care enough. I'm going to build a real estate business. I'm on this mission now to acquire 1,000 units. I'm going to do 250 units first. That's my first goal. I'm well on my way to 100 units, and I'm going to go from 0 to 1,000. I have to go down in units before I can go up in units. So I'm selling any of my smaller buildings, my triplexes, duplexes, my cottages, all that stuff's going to be liquidated and sold. My flip projects, I'm going to finish them all off and sell those off as well. So if you're interested in something, hit me up. I have like 13 or 14 properties that'll be, being liquidated. If you want to do a deal where like we JV on something, open to that. You got to qualify for the mortgage. I don't want to be bothered with it. I will put the down payment up. If someone wants me to put the 20% down as a second mortgage, okay, no problem. If they want just me to put the money up for free, I would need some equity in the deal. So I want to work some deals out there. Cool. I don't want to put any time into that. So if you're interested in taking the torch there on some of these properties, hit me up. Let me know. As far as real estate, let's think about how this is going to play out. So inflation expectations were unanchored. Inflation's been rising. We're seeing exactly what I forecasted in the spring ended up happening. And it's interesting to see that the inflation numbers are rising, but I think this is the last hurrah. And I think it will push the Fed to take things to a point of oh shit, we've broken something. So again, we talked about the soft landing. Either we go into a recession, or okay, there was a theory that we could land between, like where rates wouldn't get too crazy, we wouldn't have a recession, and inflation would get, kind of curled back to 2% slowly, I guess was the target. Now it's like, I don't think that can happen without a recession. And so how deep is the recession really is the question at this point. So yeah, that's leading me to believe, when we look at real estate. Real estate is not a liquid asset class. It takes a long time. From the minute you decide you want liquidity to the moment of actually getting liquidity, takes a long time. On average, 90 days. From the moment you decide to sell, you prep your property for sale, you do all the paperwork, you eventually get it listed, it sits in the market for a month or two in this market, and then again, like things just don't sell as quickly in a buyer's market. And then then it sells, and you got a 30 or 60-day closing, et cetera, and so forth. By the time you get cash, you're 4 or 5 months out. So you can't hit the panic button on real estate. It's hard to panic sell. In the stock market, you can sell in a second, gone, liquid to cash. That's why there's these great volatility swings that you don't see in real estate. It's part of why I like real estate. I can't check the price of real estate every day. It doesn't give me any stress. It's a business that brings me cash flow. I like that about real estate. But let's think about how that plays out in the broader market performance. What that leads to is less volatility and a lot longer for pain to happen. So as an example, if we look at historical data, in 2008, when everything collapsed, the bottom of real estate didn't hit until 2011. There was a 3-year lag. Subprime mortgage collapse, 2009, the world's ending. Real estate didn't actually bottom until 2011. That was the lowest we got the average prices. It took a while for comparable sales to hit, because once you sell, you have 4 or 5 months. Then there's a bunch of sellers who hold out for prices of last year. In their mind, they think they can still get it. So a bunch of these sellers sit, inventory builds, which is exactly what's happening right now. We're seeing, used to have in London, Ontario, as an example, because I'm a realtor, I have access to this local data in Ontario. We used to have a half a month of inventory available. Like at the current buying rate, there was a half month of surplus inventory on the market. There's currently 4 months of surplus inventory and climbing on the market. That's an 800% increase in available inventory. What that tells me, and prices haven't dropped all that much yet. They have dropped, but not meaningfully enough to close that gap. What that tells me, in most cases, this means that there are sellers who are delusional, and they think that they can get a price that they can't. And so until those sellers come down to reality and have some motivation, these newer rates that people are renewing into, we were on 3% mortgages. Now a lot of Canadians are renewing into 6 and 7% mortgages. If you have a commercial property or a HELOC, home equity line of credit, you're renewing into 8 or 9% in a lot of cases, sometimes 10% in a local credit union. You might get prime plus 2.5, which 7.2 is bank prime. So add 2%, that's like 9.2%. That's the worst case scenario. That's a different scenario than 3%. Your interest payment every month is triple now. If it was $1,500 a month, it's $4,500 a month. And if your rent is frozen in here in Ontario, what happens when we're paying $1,500 and now you're paying $4,500? That's a market shock for most people. And that results in pressure to sell. And for a while, people will say, oh, rates are going to come down, rates are going to come down. But now market sentiment is that rates are not coming down soon, maybe a year. When pain is at its maximum, people will start to sell. And when they start to sell, the number of months of available inventory will go from 4 down to 2 or 3, probably sometime in February of this year, if I had to guess, January, February of this year. December is going to start being low. Those sales from December will not close until February and March. So if the Fed breaks things, which they will, because the market people can't survive at 7 and 8% with price levels the way they are and debt levels the way they are. For a little while, we can do it, but things will break. I give you my word, a year at 7% and everything's broken. Rates have to come down. They will bail out the housing market. They will bail out the businesses. They will bail out the auto department. The whole auto sector will be in default. They'll bail all that out because we have prime or Fed rates at 6 and 7%, which is again like close to where I think things will get. And they already are in some set. Like, yes, the Fed funds rates, they're trying to target 5.5%. The Fed's fund rate has to go at least meaningfully 1.5 to 2% above inflation. It's not quite there yet. It's almost there. And inflation is actually resurging right now with the price of raw materials going up, and most importantly, the price of oil rising, which leads to transportation costs and drives up food costs. It drives up the cost of everything because everything has to be shipped, right? So that just drives the cost of everything, creates inflation. Even in the service side, you think, well, how does it affect the service economy? It's like, well, buddy used to come to your house and cut your grass for $50. Now he wants $70 because this tank costs an extra 20 bucks to fill up. So the service economy all increases their prices too. And we get a wage price spiral to an effect. Hopefully it doesn't get that bad, but that does happen. And where people can pass those costs on, they will. Or businesses specifically will pass those costs on and continue to try to remain profitable, right? So that's just a reality of what's going to happen. When that plays out, the minute that the Fed starts lowering interest rates, when that happens at that meeting, we go all in. Because at that point, you still have really great shitty comps that are closing, which you can use to negotiate really great prices before things start to shoot up. So that's the moment you want to buy. Anytime you're buying before that is speculating. Again, it's hard to know when we're in a bottom. When fear is at its maximum, that is when you want to strike. You can buy stuff now. I am buying stuff now. I just bought a 23 unit in Sarnia, Ontario. We're going to do a really awesome renovation conversion on it. We got vacant possession. I'm really excited for it. It's got a $1.5 million upside, and I'm going to be able to build more units on it too, which is great potentially. There's an adjacent lot that came with it too. So I'm excited for all of that. And so I'm going to continue buying, and I'm hoping to buy a lot of units as that turning point. As we turn and market sentiment's the most bearish, I'm hoping to get a whole bunch of units under contract. So that's my goal. That's what I'm doing. I'm shifting my net worth more into multifamily real estate. So I want to build a significant business around that. I'm excited for that. The timing is not perfect, but for me to get systems up and get a couple buildings going and start hiring people and teams, now is the time to do it. Now is the time to start so that I can get a running, into the next bull market. I can have a good run. Right now I need to start walking, start jogging, and then I can run in the bull market and acquire. And then the exit strategy is I don't ever have to exit a lot of these buildings. I may keep them forever. Maybe another bull market a decade from now and exit then. You got to remember at the same time, while there are some negative factors for real estate, there are a ton of positive things driving real estate prices. Sorry, guys. One being immigration. We are exploding our current number of temporary residents, permanent residents, student residents coming into Canada to the point where it's up 200% from where it was a few years ago. That's significant. Any landlord or any property manager, you ask them right now in London or any of the major cities that bring in students, there's hundreds of applicants coming to Canada who can't find a place to live. We don't have enough housing. So that's a challenge. And then the government set a target for 100 million population by 2100, conservatively. At the current rate of progression, we're going to head there by 2060, 2050. We're going to be 40 years ahead of our goal of 100 million people. And Canada can easily sustain that. We have the infrastructure. We have the size. We're one of the largest countries in the whole world, right? And I would argue one of the most beautiful countries in the whole world, and could be the richest if we exploited some of the resources that we have. Canada is also fairly socialist and fairly green thumb initiative. We tree hugging types. So, and that's not a bad thing necessarily, but it is for the economy of Canada. So immigration is very bullish for real estate prices, and we do have a problem where we can't build enough. And I want to be part of the solution to solve the homelessness and the lack of available housing inventory that exists right now. I have the skills. I'm good at building things. I'm good at putting deals together. I'm good at negotiating. So it's that's a place I need to be focused. You guys have heard it here. It's been a while since I've been excited about, and I'm shutting down the flipping division entirely. I don't want to be flipping anymore. I want to go all large multifamily. Now, large multifamily, interestingly, the way that I buy it is like flipping, because I buy buildings that are distressed, that need a lot of renovation, a lot like a flip, and often need to get the rent roll up. The nice thing about multifamily is that one, you're cash flow positive always. Whereas with a flip, you're stuck holding it, you may lose money, and you're stuck every month putting money into the thing, and it may not cash flow. But with a multifamily, you can hold forever. You don't ever have to exit. But the nice thing is that with a multifamily, you're in control of the valuation. If you bring costs down through certain strategic improvements or renovations and energy efficiency, whatever, you can drive your costs significantly down and you can drive revenue up. Things like putting a vending machine on the property or building a shed and putting coin laundry inside of the shed on most multifamilies is a super easy couple $1,000 project that can bring in potentially $1,000 or $500 more a month in a big building. Right? Small things like that. You did some vending machine, you did some add-on services, maybe you put a little storage shed, you rented out little lockers to people, storage lockers, $25 a month. Little things like that. You can go to a property and you can drive the net operating income up significantly. I'm talking $25 times 50 units or something is substantial, right? You get a huge increase in net operating income every year, but then that increases the value of the building. At a 5 cap rate is 20 to 1. So if you had $1,000 in income, because at a 5 cap rate, it's 20 to 1, $1,000 in annual increased NOI means your building's worth $20,000 more. That's huge. That's substantial. So $1,000 more in income. If you can bring $10,000 more in income to the building in an annual basis, that's $250,000 to the bottom valuation of your property, right on pure profit, right to the equity on your deal. So that's something I really like about real estate. So if you could help with that, if you guys know commercial realtors in London, Sarnia, and then also in Florida, send them my way. I'm looking at Daytona Beach area. I'm looking all along from like Jensen Beach, West Palm Beach, up into Daytona Beach. In that whole corridor there on the East Coast, I'm looking to buy. There's stuff there that's just fantastic. We do have one property under contract there, a 16-unit apartment building on the ocean. And so it's an exciting project as well that we're taking on. And I want to get more like it. I want to have, 10 or 20 or 30 buildings like that. And so I'm excited for that opportunity and bring you guys along for the ride, and you can learn where I fail, and you can join in on the deals if you want to. There'll be lots of opportunities all along the way. So here we go. I'm gonna go to the Q&A for a sec. That was my little 16-minute rant for you. Hey, from Alberta, David, how you doing? Brennan, hey Mike, how you doing? Rocky, hey, how you doing? David says, any luck connecting with Addy Invest? I haven't, David, honestly, put the time in, but next time I have a deal that needs funding, I'm gonna fund the first 2 deals with existing infrastructure, but in the future for other deals, I might look into that Addy Invest. And it's definitely worth reaching out, I think, to set up a meeting, because again, if they don't take too many points, they don't take too many fees, it can make a lot of sense to help scale for sure. Grinder says, hey Mike, hope all is well. Crazy when you close your short, it crashes. I know, right? I've been holding that short for like 4 months, and it's like, I finally am like, I'm done going to real estate. And just the timing of that, the stock fates or God or whatever was like wanting to send me a message to remind me that I cannot time the market and that I should not be wasting my time on the stock market, because the immediate time that I closed, 6 hours after that day, the market has gone into free fall for 7 days straight down. What kind of luck is that? You close a $6 million short and it collapses. Like, had I not touched the short at all and just left the short on, again, I set a window, right? When I put it on, I set myself a 6-month time window, and I decided to close the short because long-term, you'll always lose shorting. And I set a time window for myself. I waited, it didn't come. And I was like, you know what? I'm focusing on real estate. I don't want to be watching it every day. And of course, I would have made $800,000 had I not closed that short. And the currency adjustment on the USD as well would put me at over $1 million that I would have made. So what a shame, but I'm going to again make like, the $1 million doesn't change my life in any meaningful way. And in the next 5 years, the roadmap that I laid out for myself, just using the real estate acquisitions plan that I've made for myself to acquire 250 units and then to 1,000 units, takes me like 30, 40, 50 million in equity. So who cares about $1 million when I'm going to make 50 in the next 5 to 10 years? It's not a big deal. Focused on growing and progressing. Those kinds of thoughts are not productive, and they don't help you grow and improve, right? You don't dwell in the past. You learn from it. The key learning piece is that no one knows the future. And if they did, it'd be priced in, right? Market was not pricing in a drop like this. It was a surprise. And that's reality, is that all you can do is control what you can control for. And in the stock market, there's not a lot you can control for. You can write contracts that reduce your risk. You can look for, those squeeze opportunities sometimes where there's a bunch of theta decay, and you can kind of straddle stocks and stuff. But again, to develop a real alpha edge in the stock market, you're competing against guys who have 150, 160 IQ. But not only are they really smart, but they spend 16 hours a day. They're up at 4 a.m, reading reports, developing an edge, working with a team of people to have an edge. You're against sharks, firms, bots, all of that. In the real estate world, I'm against a 58-year-old man who doesn't know how to use a computer, who's got $50 million in a bunch of buildings, and he's stupid. His IQ is maybe 105. And maybe I'm against a gangster who runs a bunch of buildings, who's in construction, and like got a big belly and a bald head, and like just, you can picture the type that's like, oh, rentals, this is how we do rentals. We put an ad in the newspaper, and this is how we do it. Like, this is a lot of that mom and pop shit in real estate, small multifamily hotel. And then there's like, your typical mom and pop, whatever. That's what you're competing against. And then I'm competing against a bunch of realtors, like in the actual negotiation, I'm not only competing against the mom and pop seller, but the intermediary, which is often the agent. And the agent's got a bubblegum license, went to high school. And so these people are greedy, and they're self-motivated, and all they want is what they want. And the market is not efficient at all. And you're not competing against anyone super smart. So in the real estate business, you go in there and it's a business. You hire the right staff, you do the right things, you win. In stocks, you don't have control. You don't know you don't have management lying on their financial statements. I used to work at a big four audit firm. I can tell you there's a lot of corruption and a lot of paybacks and a lot of fake financial statements on the Fortune 500. Beyond that, I can tell you so many horror stories. So even if you had direct access to management, are they telling you the truth? You have no control. Most of the information is not perfect. On top of that, you're competing against some of the best minds in the world. It's really hard in the stock market to win. It's very easy in business and real estate to win because who you're competing against is just, anyway. And then in the stock market, it's crazy. Like there's meme stocks where like you'll short a stock that makes no sense and it'll go to the moon. It makes no sense. In real estate, it doesn't happen. A ship property doesn't trade at 10 times what it's worth. It just doesn't do that. In the stock market, it can do that. Things are irrational. There's even if you have models that work, every model that's ever been created has been broken. So if someone's like, hey, man, I have the best trading algorithm, this and that I built, it's like 5 years from now, that model's dead. It doesn't work. Nothing works consistently. Human psychology is always changing. It's a very difficult game to win at, and real estate's a lot easier game to win at. So that's part of the shift for me is that like, one, I have the expertise. Two, the people I'm playing against feel like they're retarded to an extent comparatively to the people I'm competing against in, like big hedge funds. When you're competing against different targets, it's just an easier game. So I'm in it to win. I know ego is a cool thing and like, it feels smart to win in the stock market, but like it's easier for me to win in the real estate world than in the business world. So there are also sharks in the business world and like you got to compete and all this, that, but if you put in enough time, you will win. And I just don't want to put in the time in the stock market, and I will put in the time in real estate. It's just a preference thing for me. I just don't enjoy reading annual reports and trying to find like tips, and I just don't enjoy it enough to develop an edge. Rocky says, closing a property last week, it's been a grind getting B lender financing. Hope it's all worth it in the end. Well, congrats, Rocky. Hopefully you can get the property up and cash flowing and it's at least covering all your expenses. It's definitely one of those things where right now, a lot of the properties we're buying don't cash flow now, but they will in the future. So rates won't stay this high for long. They will come back down. Where is the exact top? I don't know. I hope it's 1 or 2 more quarter basis point, 25 basis point hikes. That's what I'm hoping for. It may go a little higher. Any higher than that, things will break. And when things do break, and it feels like the world's going to end, the Fed will bail out. So the bailout causes a rally in real estate stocks, whatever. Like as soon as the Fed intervenes and bails out, we're all good. And the thing is, humans are weak and short-sighted. And so as soon as everyone is experiencing pain, that's when they'll intervene. So they need to break us to break inflation. They need people to stop spending. They need Airbnb travel to be dead. They need bookings to be non-existent. That's part of what they're doing. And so if you have an Airbnb business right now, you're going to start feeling it when they crush travel. You're going to feel it a little bit. That's by design. They want you to feel it. That's how they beat inflation. They need everyone's pocketbook to shrink so that people stop spending. You crush demand side because they can't really control supply side. They're not good at that. They could, but they pretend that all they can do is tackle demand side by raising rates and controlling the money supply. There are other things they could have done to fight inflation and better policy, but let's not get into that. The Fed's purview is raise rates or not raise rates, print money or not print money. And again, even the printing of the money is not really in control. Like the president, or I guess Congress, could vote to spend a whole bunch of money. And if they do, then that makes the job harder for the Fed. They have to raise rates even more. So they didn't even control the money printer. It's like 2 different bodies. So they could be fighting each other, which they have been doing to an extent. And yeah, that is what it is. But Sadak says, what do you think about Ontario resident living in Calgary or Florida, Texas for cash flow? Investing, sorry, in those areas. I said living, but I meant investing. Yeah, I mean, there's definitely more cash flow in certain states, especially like the panhandle of Florida. Like if you go like closer to Georgia, something like central Florida, like up into the panhandle, Mississippi and all that, like you're gonna get some really great cap rates. There are shitty properties there, but you can buy like 30,000 a unit, 40,000 a unit in some of those areas. You get a 100-unit building for like $3 million. It's crazy cheap. But again, your vacancy rate, super high. You're gonna have a lot of trash tenants to deal with. There are hurdles that come with those valuations, right? There are challenges that come with that, right? But yeah, there's definitely a lot of cash flow there in a way that there isn't in Ontario. The thing that I like about Ontario is that we have a housing crisis here. Well, I mean, so does Florida. So, I mean, it's the same shit. But I'll say to the extent that Ontario is, how do I explain it? So Ontario, I'll do like a pro con. So on the pro side, in Ontario, we have CMHC government funded financing. And if you can get buildings, large multifamily buildings that qualify, you can borrow, if you can improve the building, make it energy efficient, you can get enough points that you can qualify for 95% loan to value at prime minus 2%. Prime minus 2%. So when prime is 3%, they were lending at like 1.5% interest rates. Like free money. It's effectively free money. And they loan the buildings 95% loan to value. So you buy this building in cash, whatever you refinance it or private financing, fix it up, go back to the CMHC financing here in Ontario, and they refinance you at like free money, 95% loan to value based on what it can carry on cash flow. Unreal. Those programs, to my knowledge, don't exist in Florida, where you could borrow 95% loan to value, a large multifamily, at prime minus a couple of percentage points. In Florida, everything's 8% interest rates. So 8-9% for mortgages. Yes, you're 25-year fixed, whatever, but they're just different in that sense. Other interesting thing in Ontario, we don't have taxes on our mortgages here. So refi is pretty cheap. Refis are really expensive in Florida. You pay a huge state tax to refinance a property. So that's just two differences. But yeah, I mean, I love Florida. I will continue to diversify. My US exposure is going to be in Florida. The reason I chose Florida is one, I think it's going to grow faster than almost any other state. So the demographics and immigration trends, that's all really bullish for Florida. Two, I understand and know Florida. I've been going there every winter for years and years and years. I snowbird there, so I'm physically there. So I have a physical geographical advantage. And going and checking your properties is required. You need to physically be present several times a year. And I don't want to be physically present in Ohio, 10 times a year, 6 times a year. I don't want to spend time in Ohio. I made up Cleveland, Ohio, whatever. You pick like some shitty state that also has good valuations, right? In the US. So for me, that's part of why I'm drawn to Florida is like, you have to pick based on a whole bunch of factors. And one of them is like, it's a business. Do you want to run a business there? Is it business friendly? Florida is very business friendly, as an example. But Ontario, the really thing that's driving Ontario is one, I have a really good network of people. I know a lot of people, and my network is large here. I have a big brand here. People know me. And so I can get contractors like that. I can get property managers like that. I know a lot of realtors here, so deal flow. It's just easy for me to build a business here, again, because my people are here. That said, I'm building that also in Florida now. I don't be interested in building it anywhere else. So I know you guys are sending me, I'm getting great deals. People are sending me out east in like New Brunswick. People have been sending me like deals all over the place. In Alberta and Edmonton, I was getting some deals being sent to me. I have deals sent to me like Georgia and like all these random places. And it's great, and I love it. And thank you guys for sending me so many deals. But if you can, try to focus it in that little eastern coastal part from Daytona Beach down to West Palm Beach. Send me stuff in there if you can. And then also in Ontario, in London, Ontario, and Sarnia, Ontario, maybe all the way to Grand Bend and a triangle like that. Anywhere in that area, send me some multifamily there. I'm all over it in Sarnia or London. It's hard for me to build out in other areas. I know there's great deals all over the place, but those are the areas I'm going to focus in on. It's not smart to spread yourself out really thin. To grow a business and get scale, you need to go hard in a siloed area and become the expert in that thing in that area. That's what I'm going to do. Then I'll expand out once I've gone deep. So I need to go deep. I need to build out a couple hundred units in these two markets. Then I can look at another tertiary market. Once I have the systems in place and a COO who's running the business, then I can say, hey, can we sustain a fourth location? Can we add 50 units, right? So for me, it's just about leveraging existing systems and people. And as I build that business out and I have the right people tapped to do that, and I have the scale to afford to hire people, initially as I hire people, I will lose money. But as the business grows in scale, I'll be able to afford the cost per unit of that staff will go down and we'll get to economies of scale. And then it gets really sexy. Then we can throw on a ton of inventory, a ton of units into the portfolio. So Don Tran, thank you again. Says a cut live stream. Awesome. That's you're a paying loyal monthly subscriber. I appreciate that. YouTube appreciates you. Keeps the channel alive. So thank you. Joseph says, hope all is well. Looking forward to your growth and your expansion with hotel acquisitions. Maybe you could be the next Ben Mala. Excited to see the next level. Well, I mean, yeah, because I'm 30 years old, what I could accomplish between now and Ben's age, if I don't have like 10x what he has, I must have failed royally, right? Like age-wise, I'm way ahead of where he was at my age. So I just have to keep that trajectory up for sure. I like Ben. He's a funny guy, larger than life personality. And I drove by his house in Florida there, and it's a cool spot. yeah, anyway, good guy. I think that he's a funny guy. But yeah, I mean, over a lifetime, there's no reason that you can't have $1 billion in assets under management. Like, if you just acquire like one building, if I just acquire 1 billion a year, one deal, that's like so part time. But if I do one deal a year, I get billionaire. So it's like, it's so easy. You know, if you just run a model where things continue to compound and grow. The only way I don't get there is doing stupid shit like crypto. And I think crypto should be a part of everyone's portfolio. 2 to 5% of your net worth, throw it into Bitcoin. But like stupid shit, like the crypto mining that I did, some of the NFT, altcoin stuff I got caught up in. I didn't put a lot of money into that, but still, those types of investments, type of speculative get rich stuff, that isn't what the rich do. Like, that isn't the way you get rich. That's how most people lose everything, is investing in stupid shit. So don't do that. Invest in quality things, build your business out, and over a long period of time, it will compound in your favor and you will be rich. There will be many zeros added to your net worth over time. So heed my advice. I often don't heed my own advice, but I'm trying to. The last year has been brutal, to say the least. I've had a horrible hit to my net worth just investing in, like options trading. Crypto has crashed, the whole NFT, crypto mining, even real estate is in the shitter, 20% valuation drops. That's substantial, right? If you had a 40% equity in a property and the market in Ontario here dropped 20%, that happened in London and surrounding areas. Some areas dropped 40%. Some of the cottage country areas dropped 30, 40% from their peaks. Imagine you get 30% down and the market drops 30%. Your entire investment is zero. You went to zero. You can go below zero with real estate. So there is risk with real estate too, but again, I like that I can buy an asset undervalue and I can cash flow it. And over the long term, I always win. You don't have to sell if you're cash flow positive. You can hold forever. So it's fine, right? Whereas a stock, if it's not cash flow positive, you maybe can't hold that position forever. There's this saying in the stock world, it's like, the market can be irrational longer than you can be liquid. The market can't be irrational longer than you can stay liquid in the real estate market. You have staying power. And also mortgages are non-callable. The stock world, they can call your shares. In the real estate world, they don't want to call your mortgage. They want you to keep paying it. They don't want it back. Very rarely are there mortgage calls. And if there is mortgage calls, it's a collapse and they want the landlords to keep operating because they don't want to take over portfolios and operate them. They would prefer to keep collecting a rate. In most cases, you can take your loan back to the bank and renegotiate the rate and the payment terms and extend things out because it's a crisis. So real estate's, it's designed for collapse. It's designed for all of that, right? And again, the government doesn't want to see it fail, so it will get bailed out. Harriet says, any catch using a cashback realtor seems too good to be true because it's like a flat fee realtor. No, definitely do that. I've used cashback realtors too. They're great. I've done it for people before. I can refer people to cashback realtors. On the buy, there is 2 or 2.5%, between 1.5% and 2.5% commission that gets paid to a buyer's agent. If you know what you want, go and find an agent who will give you a percentage of that back because that's just easy money. Why wouldn't you collect a nice acquisition fee that would have gone to an agent? That said, sometimes agents provide a lot of value and they earn that commission that they have on the buy side. So if you're a brand new buyer and you know nothing, there's a lot of value. But if you're a seasoned investor like I am, a lot of these agents know less than I do. They're not adding any value to the transaction. I'm a realtor myself, so again, on the buy side, I set my commission to zero and I represent myself. But again, there are opportunities where in Florida, I'm not licensed right now. We have Investors Choice Realty, our own brokerage here in London. So if you do want to buy a property, hit me up. I have a partner I can refer you to. Again, we have our own, basically our own brokerage, Investors Choice Realty. All we do is investment properties. Hit me up for that if you're interested. I've had that for years. But in Florida, as an example, is my train of thought. I partner with agents there, and I do a commission split on the buy. When I sell properties, I refer the business out and I do a discount. That's what you do as a realtor. That's normal when you refer a client. You can refer yourself if you want to save commission. Is there any way a Canadian can invest in American residential real estate and avoid the mandatory 30% rent tax for foreign investors? Yes. So one way is to find a U.S. partner and put them on 51%. So it's a U.S. corporation, and then work out a side agreement where they pay you to your Canadian corp when you invoice them, maybe for consulting services or something like that. So there are ways. to do it. There are also strategies where Bahamas Corps own US LLCs, and you can't get the money repatriated back to Canada very easily. But if your plan is to retire in, say, the Bahamas, that corp could begin to build a lot of income. And there's no capital gains tax there, there's no income tax there. So that could be a way to funnel things back, is using offshore bank accounts. Of course, that offshore bank account, like the entity that owns the US corporation, is going to have to pay tax on US real estate. There's no way around it. The way that I understand to get around it is having some sort of like Dubai Corp or Bahamas Corp. They could be the active management and rent the IP to an active management corp, flow all the profit there and invoice it out. And now that management company that's not located in the US, that owns the IP for the management software, is taking most of the cash flow, most of the profits being taken away because there's a lot of expenses. And those expenses bring your profit to near zero. If there is no income operating, until you sell the building, you could run it at a net neutrality, like a net no profit, in which case there is no tax. It's only if you show a profit, there's tax. So eventually, when you sell that building, the US government is going to take a capital gains tax on you, which is like 28% or something on your gain. So there is no way around tax investing in Canada or the United States in real estate. It just unfortunately is the way that it is. You got to pay tax to play the game. But there are ways to run for a long time to build a huge portfolio. And then you can use creative life insurance policies to get the money out of the corporation tax-free. So there are lots of complicated strategies that accountants know how to do. Go hire the best, pay top dollar, and you will get a good strategy. And every strategy is different for each person. So, boom, boom. If you move to a new city, what would you use to keep your finger on the pulse of a market? For me, it's looking at every single listing and understanding what people are listing at, and then looking at the sold data to see what are they selling at. That would give me the most, reliable data. That said, you can look at average and median house sale prices, compare that over time to last year and the month before. All that's available online for the most part. They publish all of that. If they don't, talk to a local agent. They 100% will, they will know that data. So call some agents who are, data driven, and they'll have that data for you in that city. So you can look and understand that market. But data driven. You have to be data driven. Demographic trends, average income trends, all that's super important to understand who your renter is and who your buyer is. Whenever you're buying a property, you have to understand where your exit is going to be. Even if you plan to hold it forever, have exit strategies in place because things change, shit happens. London is home, boom, 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 true. Next comment was, Mike, is there any benefit in doing financial advisor courses? You mentioned a few sessions ago you became a financial advisor for some time. I'd love to hear your experience. So I did a small stint at Freedom 55, and I got my LQP. It was your insurance license, and they also do mutual funds. So the challenge with mutual funds that I had was that you're nailing your clients with excessive fees, and I couldn't swallow doing that to people. You have to provide really great advice to justify taking a 2% management expense ratio, which a lot of that goes to the brokerage, but some of it goes to the agent too. That's how they get paid, right? I think fee-based advisory is better. That said, poor clients benefit a ton. The thing is, none of the agents want to take on poor clients because $10,000 invested times a 2% fee is a couple $100. It's not worth it. So poor people just building their portfolio, working class people, they can't afford a fee-based advisor at $300, $500 an hour. The rich people can and should. The problem is when the rich people who have large portfolios go and pay a percentage, 2% drag. If you pay a 2% fee on your portfolio over a 40-year period, you've given away more than half of the value of that portfolio would have been. So if you would have had 50 million in 40 years, you're gonna have 25 instead because that fee 2% compounded over all those years. So it's a tough thing to convince anyone of the idea that an active manager taking a 2% fee can outperform the market. Because statistically speaking, 99% of mutual funds over a 25-year horizon lose to the S&P 500 benchmark or whatever their benchmark is, net of fees. Not before fees. They'll always advertise they're beating the market, but are they beating it net of all fees, including the advisor fees? Not always, very often not. So it was something that I struggled with. But I do want to solve that problem. I think robo-advising is going to solve that problem in a big way. There is extreme value in financial advice for the average person who can't delay gratification. Like a lot of these people will spend whatever they make. And if you don't take 20% of their paycheck at source when it comes out and invest it for them and help them through that and build them a plan that they have to stick to and then be an accountability partner for them, they won't save anything. And so the large majority of people do need a financial advisor because they just don't have the discipline. Even myself, like I sometimes, in my trading, not my saving, I have no problem saving, I'm super frugal. But in the investing side, like it would have been helpful a lot of times having a trading partner or a trading accountability coach to be like, Mike, does this trade make sense? And it's like, is this an ego trade or a revenge trade? Like, what's the exit on this? Think this through. And like having that person to bounce things off can result in you becoming multiple factors wealthier that more than justifies the 2% management expense ratio. So that's the other side of that coin to kind of think through it, right? So was it worth it? For me, no. Like the dollars per hour were not worth it for me. I would love to own a financial education business. I think there's a lot of value in that, like a robo-advising platform or something. I would love to take a minority stake in. I'd be happy to help think through models that would help make people wealthier over time. That's something I'm very passionate about. But doing it on a client-by-client basis as a full-time job, and to do it as an advisor, like a full-time advisor, you can't really do it part-time and do it well. So I had to decide, like, do I want to do this full-time? And it came to the point where I just didn't want to do it full-time. And I didn't like that I couldn't post what I wanted to post. I couldn't say what I wanted to say. You're very restricted on every post, every video, everything you're doing. And I just didn't like that. So for me, it was like, I'm out. They're like, take your blog down, take all your LinkedIn posts down. You can't post this, you can't say that. And I'm just like, I'm out of here. Like, I don't need this. I don't need a job. I was not here for a job. I was here to build a business, and this is not what I'm looking for. I don't want the scrutiny of the government entities that control the mutual funds industry. So for me, it didn't work out, but there are lots of financial planners who enjoy it. I also enjoy conversation about financial planning. I love anything to do with, personal balance sheets, financial plans around like building wealth and strategizing your business and tax and all that. That's my jam. Like if I could pick a job that I would like more than any other job, it'd be that. The problem is it just doesn't pay enough for it to be worth it for me. Like at my net worth level, the only thing that is fruitful or worth my time is just getting a higher ROI on the wealth that I have. So unfortunately, there's no job that pays me enough. There is no job I could take right now that would pay me as much as my passive income for my net worth. So it's like you couldn't even pay me 500 grand a year. It's nothing. Like just getting a little bit higher percentage yield on my portfolio nets me more than 500 grand a year. So it's like, it became really hard. And now more than ever, as you get wealthier, it's so hard to want to do anything except for maximize your net worth. That is the job. Like the family business becomes just managing the assets because that's your highest and best use in many cases. Although the last year, I don't know if my trading performance I should have outsourced that, to be honest. I've not performed well. What a shame, eh? My timing was so bad. But such is life. Okay, Hong Kong Fui says, if you move to a new city, that was the last question. So the next one here is from Chuck Norris. Hello, Mike, thanks for the great stream. When you were starting, what was the top thing you looked for in MLS deals? I looked not for MLS deals, but in this market, you can find deals in MLS. So value add. I would say number one is value add, number two is cash flow. They would sometimes switch, but like, can I carry this property in a worst case scenario? And so you have a lot of positive cash flow. The answer is yes. If shit gets bad, you're all good. The second one is a value add. So I wanted to have, if I have to sell this property because something happens, the world, implodes, I need that cash, can I exit for more than I bought it for, net of all transaction costs? And that's a tough one because most properties don't meet that metric. You buy it for 500, you need to sell it for 600 just to clear yourself, right? So it's like, how do you buy a $600,000 asset for 500,000? Well, that requires a lot of analysis. How do you value property, right? It comes down to understanding comparable analysis, understanding rental income approach, understanding the cost-based approach to valuing real estate. All of those things are important, and you need to understand that before you go and buy property. So you definitely have to go deep, I think, to become an expert, but anyone can buy property. I mean, not everyone will do it well. Most landlords don't know what they're doing. They just buy something because they like it emotionally, whatever. A lot of them don't even run the numbers, and they do okay. I'll slay them in competitive battle, because again, they're performing down here and I'm going to perform up here, but that's okay. You know what? You can get to a $10 million portfolio or a $20 million portfolio just being an idiot, just buying a property here and there throughout your life. Every couple of years, buy a property, refinance, buy another one. Like, you can be really bad at real estate, horrible at cost control, horrible at renovating, bad at property management, and just bad at buying, and have no regard for financial spreadsheets or underwriting deals properly, and still do well in real estate. That's why it attracts so many, contractors. And like, think of like the dumbest plumber you've ever met, who like can't even hold down a job and jumps between jobs and works for himself and takes cash. A lot of those guys have a rental property or two or three. Meet these guys and like they've been sniffing glue. I chose a plumber. There's a lot of really great plumbers that I've met along the way, and there are some really smart plumbers that I know, some great people. But I've met some plumbers along the way that have sniffed a little too much glue, and there's a couple of screws loose. And some of them are multimillionaires. Plumber next door is a multimillionaire. My point is that's not impressive. Over a lifetime, if all you can accumulate is a couple $1 million, you've failed. Radically failed, in my opinion. It's so easy to just start at 18 and stick with it. And if you acquire a property, one property a year, it's fucking jokes. If you saved half your income for the first couple of years and then just didn't save any more and just reinvested that into more properties as they appreciated in value, refinanced, it's it's hard not to build a large portfolio. I don't want to discourage anyone. If you're a plumber out there, like, it's a really good paying job. You can make like 200 grand a year as a plumber. So like, you're probably doing better than the Ivy graduates that I know. I know some trades guys who make way more than the smartest Ivy graduates that I know. So sometimes being book smart is a flaw in real estate. Some of the book smart guys make fatal mistakes. They don't understand construction. They don't understand working with their hands. They can't manage people well. They're like autistic when it comes to having a discussion with someone. The contractors, extort them and they get taken advantage of. So even the really book smart guys don't necessarily outperform the plumber who understands how to fix a faucet and doesn't get taken because he's, a tough guy. That guy might perform better over time than the super smart guy. What you ideally want is somewhere in the middle, where you can kind of have that real world practical understanding of how the world actually works, as well as mixed with, some academic, back end paperwork. That was maybe a little bit too much. I'm sorry, guys, if I hurt any feelings. Do you think the Canadian banks could be in trouble? Yes, to an extent. I think Bank of Montreal is in big trouble right now. TD, some of the banks that are stuck with fixed variable rate mortgages. So the payment is fixed, but the term is variable. A lot of them are collecting right now monthly payments that are fixed that don't even cover the interest on the loan. So they were actually extending the amortization out to 80 years, 90 years in some of these mortgages, which is akin to, like, if their book is not collecting the principal back and they've lent other people's money and there was ever a run on the bank, that would be a problem, right? So Bank of Montreal is an example. I have it on good authority, unsigned information from someone who works there, that they've almost froze their lending. And this is public knowledge, but they closed down their entire auto lending business and fired everyone. So the big 5 banks in Canada are struggling. The ones that aren't struggling are like Scotiabank, as an example. They've just increased your mortgage payments. They're not leaving it fixed. They're like, your mortgage payment was $5,000, now it's $7,000. We don't care. So that bank will be okay. And now the default rates might be a lot higher, so they might not be okay. I don't know. So you have to run through a lot of the analysis. I haven't done it. I, last week, called out a short on Bank of Montreal. It's since fallen almost 5%. And I said, look, I would short Bank of Montreal till it drops 10%. I wouldn't go all in. I would hedge hedge in case things rally, but put on a spread with a bear direction. And I said, that's probably a good play right now going into this winter. Shit might get bad. The good news is that the government will bail out the banks. So nothing will ever collapse here. Because again, we have a monopoly of a few banks and the government will bail them out 100%. No bank will fail. But will there be pain? Will there be stock decreases in valuation? Will there be, lending tightening? And that's happening. They're not lending. Like almost no one, even their preferred clients with large assets with them, they're like tightening up their lending, super tight. So that's just a fact. That's what's happening right now. And that lack of liquidity as the banks tighten up makes it a lot harder for properties to sell for top dollar. And so you'll see less and less buyers, and eventually prices will fall with that, and they're maybe 5 or 10% this winter. So I've been calling for it for the last year. This winter, I think, will be the bottom. We may have a double bottom where it peaks again in the spring and we go a little bit lower the following winter. I wouldn't not buy anything on that speculative premonition because it may be the bottom this winter. I don't know. it's possible we have a double bottom where things bounce again in the spring next year and then go further down. It's hard to call the bottom. None of us really know. Things are cheap and there is no competition right now. So that's something to think through, guys, right now. If you're looking to buy, I think it's a good time. I really do. What do you think about taking on debt, planning on paying back with hyperinflated currency? Do you think there will be a period of time where it'll be difficult to make payments? So in general, taking on low interest debt against an asset that is appreciating in value with inflation or beating inflation and producing cash flow to service the payments on that debt, that is so smart. Because again, inflation will cause the value of that debt over time to be worthless. So yeah, the Fed has been clear that they don't want inflation running out of control and expectations, running out of control. So I think the Fed's serious. The last talk, they were talking dirty to us. I think they're going to get inflation under control. And I think that they will anchor those expectations and they will raise rates until they break something. Because the alternative, and the Fed keeps saying this, and I like that he says this because it's true, so true. And the US sets the stage, so Canada has to follow suit. But the thing is, he said inflation expectations and inflation unanchoring and running wild is worse for the economy than any damage attributed to high rates. It's true. Inflation is the worst cancer we could have in our economy. And so they will not let that happen. What we saw in the 70s and 80s won't happen in the same way this time. It will be different. Rates will go high. But we're seeing inflation at like 4%. We're seeing, maybe the Fed's fund rates to get to like 6%, which means mortgages might get to like 10 at the max, 9-10% at the max. At that point, at current valuations, where current debt levels are, things start collapsing, things start breaking. So and when things start breaking, the Fed has to ease up. The Fed won't even have to, it won't even be a stimulus thing, I don't think. It may be. Okay, so one scenario is that the government bails out and rates stay high. A better scenario is when things start getting really shitty and we're in that pain this winter and everyone's feeling the pain, all the small businesses, all the businesses are contracting and it's in pain. What will happen is the Fed will say, we are achieving our goal of a 2%, 2.5% inflation target. All is good. We're going to start lowering rates. Or we're going to hold. We're not going to raise things anymore. And then we're going to start lowering rates. That is the news we want to hear. And that is coming. From a financial standpoint, do you think leaving Canada is a good idea? Grand Caymans is not. I like Bahamas because you have to spend 90 days a year there to get residency. So that's great. It's close. It's 50 miles from Florida. It's a 20-minute flight from Miami. It's close from Canada. You're not going across the whole world. So if you want to spend some time in Canada and run a business in Canada and run a business in for me, Florida, geographically, Bahamas is fantastic. It is one of the best tax geographical spots. Dubai, you got to keep going to Dubai, and it's far. And women aren't treated the best there either. And there's a number of other considerations in Dubai. And also, there are some tax talks coming to Dubai. So I don't know where Dubai will sit a few years from now. So we will see. We will see. I'm more bullish on Bahamas over Dubai. But yes, is the tax considerations? There are a lot of tax considerations. And it is expensive to stay a tax resident in Canada. I shouldn't be. I am because of family reasons, to be honest with you. That's why. But it is expensive. I will pay hundreds of thousands of dollars in tax every year. I could own a mansion in the Bahamas with a staff, just in the tax savings alone. So it is very hard. And it will become harder as you get wealthier. I don't know how. Well, the ultra wealthy just don't care. Like a couple million in tax a year, whatever, they don't care. So that must be why they stay. I don't know. Or they set up offshore stuff and still stay. I don't know. They bleed the corporations to nothing. I don't know how they do it. But yeah. If you were to start all over again in Canada, which city would you buy into and would you scale? So wherever I live, as long as it cash flows, that's where I would buy because I have a geographical advantage. All right, everyone. I want to wrap up tonight's stream. Remember, do your due diligence. Do your due diligence. One of the wisest pieces of advice that I can give you is spend twice as long underwriting your deal than you do anything else, because the underwriting of the deal is so important. Making sure that deal is right. Don't be afraid to walk away. Don't be afraid to negotiate. All that stuff at the outset is where you make most of your money. So Yeah, thank you everyone so much. We'll see you next week. Where I think Bitcoin's going, probably down and then up. I think 100,000 a token, no problem in the next 5 years, guaranteed. But I don't know where it's going to go in the short term. So who knows? All right, everyone. See you next week. Remember, the secret to unlocking wealth through you is 3 levers and control your financial future. Spend less, earn more, and maximize return from the difference. Bye, guys. See you next week. Remember, at Mike Rosehart on Instagram and on Facebook. Please, someone share that you watch it tonight and tag me, and I will reshare your story on my story. So that'd be really cool. If someone's got Instagram, Facebook, and they want to tag me at Mike Rosehart, find a little blue check mark beside my name, tag the real one, not a fake account, and I will reshare you.